Welcome to the Rigatoni Capital Podcast. It is Saturday, March 7th. I come to you on another gloomy day on Wall Street. But Wall Street is, the stock market's closed, of course. It's the weekend. It's also a special podcast as it's my birthday. And I enjoy doing this so much. I came on even on my birthday. That's how devoted I am to trying to get this podcast to run properly and still the edits, it's cutting out my words. I really can't figure out what it was, and I kind of keep revising on how to edit this so it sounds better. So I apologize if the other podcast was like choppy and my words get dropped. I'm trying to fix that. Can't promise you it'll work this time. So we had like the craziest week of all time. That's why I started this podcast, because I figured it was a great time to come on and talk to long-term investors who actually are kind of like not new to investing, but they're past investing 101. So I'm talking to the medium investor, somebody that has their own portfolio on the side, in addition to something like maybe a 401k. And so they're playing and they're investing, but they want to be a long-term investor. They don't want to day trade kind of stuff. That's kind of, I think, my target market. People that are pretty familiar with stock investing at this point. They read a Buffett book or two or whatever, The Intelligence Investor, and they're kind of like past. They've had a few years experience in investing by themselves. I think that's who my target market is. Anyway, what I wanted to say was, I wanted to show you the VIX. We talked about the VIX crossing this resistance line. So we ended above 29 on the VIX, and we ended up WTI above 91. Okay, and nobody's trying to time anything. We're not traders, we're not hedge fund managers here at Rigatoni Capital. We look at the information and then we try to find value anywhere. I like to buy when things are beat up. I like to buy when there's blood on the streets. I like to buy when something is trading below its intrinsic value. I like to buy falling knives, which you're not supposed to do. That's very naughty. Nobody buys falling knives, but I buy falling knives. That's what's going to bring me to my discussion about Goldman Sachs in a moment. Wall Street Journal's headline news: America braces for oil shock as Iran war throttles supply. U.S. oil prices this week skyrocketed at their fastest pace on record. Yeah, like U.S. crude futures skyrocketed to 36% above $90 a barrel. And I'm guessing crude was up 30% for the week. That's what I'm going to guess. The VIX was up like 48% since the war started, I think. And the VIX was really low there for a long time. And we'll talk about gas prices and why there could be a little bit of a sell-off in like planes because of jet fuel, or maybe something like a waste management. Maybe their margins will get hit or something like that because gas prices go up. Just using that as an example. So, and transportation and stuff like that. But they usually we'll see a quarter. This could just be a one-time hit. Let's say they have a margin compression for just a quarter. That's probably what investors think, and these stocks will come right back if there's any pullback. Assuming this will be a shorter war. And then it shows you right here. What is this showing us? U.S. future price performance between gasoline and crude oil. And a lot of people are going to compare the 1970s oil shock to this time frame. So what a crazy week it was, huh? That's why I started this podcast, like I said. Here's Polymarket saying that bettors believe that 84% chance that crude will hit $100 by the end of March. By the way, as I record this video, Trump is hosting a summit aimed at combating cartels. He's in Florida right now, so he'll probably mention a few quotes about Iran, and who knows what that will do to something like Bitcoin that's trading right now, or gold, while the market's closed. I told you guys yesterday I added Goldman Sachs to my watch list on Thursday, and that I would kind of do a little more digging into Goldman Sachs. I'm not going to do a deep dive on Goldman Sachs. That's not what this podcast is about. I'm showing you that it's hitting the 200 day. It's about to kiss the 200 day. Obviously, it's got a little bit of private credit exposure, but when I was doing my research, it seems like it's really a small piece of the pie. Like, I don't think there's a lot of contagion. Obviously there was contagion with BlackRock, which was a little surprising to me that the stock got hit that hard. But like Goldman Sachs, their two main businesses are the global banking and markets, GBM. This is the classic, where they advise companies on mergers and acquisitions, help companies raise money by issuing stocks and bonds, and trade financial assets for clients. That's called the global banking and markets section. And that segment generated 41 billion last year. And then they have the assets and wealth management side, which is where they manage money for individuals and institutions that are very wealthy. They oversee 3.6 trillion AUM. And this is where some of the business does touch the private credit space. But that segment only generated 6.7 billion in revenue in the year 2025. So the global banking and market segment is the big one. That's where they make a lot of their money. That's their largest segment, of course, or their largest source of revenue. And let's see, full year revenue. I did this yesterday on fiscal. Full year revenue was 58.3 billion, up roughly 60% from 2019. Of course, we had the big bump in 2021 where the business was thriving because of the lockdowns, then the low interest rates, then the hot M&A IPO market that happened in 2021. All those all those type of companies like a Robinhood IPO'd, and Goldman's should have been part of that. So that was kind of like an anomaly, but it looks like they're kind of getting close to that again, right? As you can see, last year they did really well. They had a really good quarter and quarter four that they just reported. And what I wanted to show you in this chart, if you can see it, is what metrics you want to look at when you look at these type of banks or these type of financial institutions, right? You want to look at the buyback yield, the dividend yield. You want to look at return on equity, operating margin, and net profit margin. These are a few of the ones that I'm interested in looking at, whereas you don't want to look at free cash flow, of course. It's not a tech company, so that's not the way to measure this type of asset. And yeah, I mean, this company is no joke, to be honest with you. When I was looking at it, what else did I find out? The M&A backlog just hit a 4-year high. We know that can always, these IPOs, if we're in a bear market and there's trouble in the Middle East, some of these IPOs may get delayed, and that would be a negative. There's roughly 1 trillion in private equity dry powder sitting on the sidelines waiting to be deployed. David Solomon, the CEO, specifically said he expects 2026 to be a very, very good year. That was before the US-Iran war. That was before a lot of things happened, probably. And let's see. They increased their quarterly dividend 50% year over year to $450 per share. It's probably about a 2% yield, a little over a 2% yield. They've got $32 billion in remaining buyback authorization. Management's message is clear. If they can't find great places to deploy capital, they'll give it back to shareholders. And then again, to show you their segments of the business, it's really just the global banking and markets segment, which is in blue here. And then the orange is the asset and wealth management business. And as Goldman's was in that Apple Card personal loan type of business, and it was just a small piece of the business that they were trying to grow, and then they're like entirely out of that now. They strategically exited that Apple Card experiment they were doing with Apple. It was just a distraction. It was losing money. It wasn't working out. But hey, they tried, and good for them for at least trying. I mean, as you can see, it did make some money over here in the purple in a few years. But yeah, they want to focus more on what they're good at. And that is the M&A advisory type of business, the underwriting. And this is going to trade on macro. Goldman's will correlate with macro background drop. So it can be cyclical in that sense. And I'm not telling you I'm going to buy Goldman Sachs here. Ryan, the pool guy, says solid dip. I'm buying Monday. I said good luck. Not sure I'm going to. Undecided at the moment. I mean, if I had a shit ton of cash just sitting on my balance sheet right now, I would be buying it probably. So I'm undecided. Let's say that. And hey, because I don't have a lot of cash on the sidelines and I'm a buy and hold long-term investor, I've showed you my portfolio. I buy and hold stocks forever, almost. I've held Lockheed Martin for 11 years. I've held Nvidia for many, many years. I'm up 4,000% on Nvidia. So the type of investor I am. But hey, if Goldman Sachs I buy it here and it bounces off the 200-day like this, I mean, I might swing trade it just because I don't have a lot of cash on the sidelines right now. Okay. And I also want to show you the post I did on Substack under Rigatoni Capital. Financials may be entering a Goldilocks era. That was of July 15th, 2025. So you can laugh at me all you want because I was a little off there. But financials did well, I thought. I don't think they did really badly. If the Federal Reserve begins to lower short-term rates and the yield curve steepens, banks could benefit nicely. This is called fund short and lend long. So that's what we were hoping for. And then when I look at the US 2-year, 10-year spread today, it's not much of a change since then. And I think that has something to do with the little QE we have been doing. It's not really enough. And the 10-year is really just jumping around here in a range between high 3% to low 4%. And that's the 10-year. It's spiked here. Look at this. It hit a low apparently it hit a low. It was trading below 4. We talked about that, I think, on this podcast. It was one of the first days, and I couldn't believe that the 10-year was trading below 4%. But we're back all the way to 4.13%. So this was a post from Sashank Joshi on X. Fascinating on the critical minerals consumed in U.S. weapons in the past week and the time it will take to replenish those. And gallium, which is a rare earth, is a particular concern. So he puts this out, months needed to replenish expended weapons. In orange is the months to replenish at target rate, and in brown is months to replenish at current rate. And I wanted to familiarize myself with what these weapons were. And like for example, this is GBU 57. This is a 30,000-pound bunker buster bomb designed to destroy deeply buried and hardened underground facilities. The biggest non-nuclear bomb in the U.S. arsenal made by Boeing, specifically designed with places like Iran's Fordow nuclear site in mind. These SM-2s, SM-3s, this is a family of Navy ship launched missiles. I guess they're like cruise missiles. THAAD is the Terminal High Altitude Area Defense, a land-based system that shoots down ballistic missiles in the final descent phase, made by Lockheed Martin. All these weapons on this list are either made by Raytheon, Lockheed Martin, and of course other defense contractors, I'm sure, like Northrop, but really it seems to be a theme here. It's Raytheon, Lockheed, on these type of defense systems, these types of long range cruise missiles. You get the point of what I'm trying to say, is that it takes a while to replenish these, and that's kind of concerning. If I go to his post, he says, I don't know whose analysis this is, but it says per our analysis for the AN FPS 132, and that is a warning radar system that detects incoming ballistic missiles from thousands of miles away. It's probably made by Raytheon. They're probably one of the contractors that make it, or the only contractor that makes it. It will take up 5 to 8 years for Raytheon to build a new radar at a cost of $1.1 billion. Meanwhile, Lockheed Martin will require at least 12 to 24 months at an estimated 50 million to 75 million to replace this ANTPS. And yeah, I don't even know what the ANTPS is, but I guess they're trying to explain to you that what I was trying to explain to you is that it's going to be harder to get refined rare earths now, and gallium is one of the inputs that we need, and that all comes from China. Oh, look, it says it right here. A material for which China controls 98% of the global supply. Again, that's refined, I'm guessing, and it's just something that is interesting. And then Trump had a Truth Social last night, or yesterday afternoon, I think, just saying that we just concluded a very good meeting with the largest U.S. defense manufacturer companies where we discussed production and production schedules. They have agreed to quadruple production of the exquisite class weaponry and that we want to reach it rapidly as possible. So did they talk about, is this a bad time, President Trump, to bring up buybacks and dividends? Because it would be nice. I own L3 Harris, Lockheed Martin, Northrop Grumman, and Raytheon. It would be nice to know I can get my dividends and share buybacks as a shareholder. But these companies, I guess, are going to be making a lot of money either way, right? And breaking news, I saw this yesterday morning. Oracle drops after report that it and OpenAI scraped plans to expand a data center site in Texas. Was this Stargate? Yeah, it said OpenAI and Oracle jettisoned plans to expand a data center site in Texas. That is part of Project Stargate. And all of these chip stocks are selling off right now, actually, because of China. Trump new US export controls on these chips. Keep going back and forth on those export controls, and that's a political discussion there that I'm not going to get into, but I disagree with it. I think it's Brad Gerstner. His idea is the same as mine, is that why are we holding back our AI chips to the world? Even if we're in an AI arms race, holding back on these chips does not help us in the AI arms race. It's like doing more harm than good, in my opinion. See how fast gasoline prices are rising? This was from the Wall Street Journal yesterday. An average price of regular unleaded gas on March 6th now is $3.64. It was before the Iran conflict around under $3, around $2.95. And it shows you a state-by-state breakdown. Here's a look at which states have been hit hardest by rising gasoline prices. Pennsylvania, 0.41 cents. That's a big one. New Jersey, 0.31. New York, 0.25 cents. And then it breaks down. Check your state's current average prices. So Pennsylvania is 357 average price. New York is 332 average price. Jersey's 328 average price. Florida's 343 average price. And look at California at 505 average price. So that's my whole point here, is that this is the big news story. 20% of the oil that goes through the Strait of Hormuz is stuck there. So you kind of can take that off of the table. And I'll play this funny post from Landman for you guys, just for shits and giggles.
You want oil to live above 60 but below 90. And don't get me wrong, we're still printing money at 90, but gas gets up over 350 a gallon, it starts to pinch. It hits 100, every product in America has to readjust its price. $78 a barrel, that's about perfect. You know, it brings enough profit to keep exploring, but it don't sting as much at the pump. Unless, of course, here in California, I mean, they tax the shit out of it out there. It could be $45 a barrel, and it's still $4 a pump. I don't know how those son of bitches do it out there. 2020, a barrel of oil was worthless. And this place became a ghost town. And nobody's immune. Kids have to quit college.
Okay, you get the point. Hopefully that video plays. Sometimes it cuts out my videos. I don't know why. And then, of course, the other headline news is weak jobs report likely to keep Fed on hold in wake of oil price shock. It's the headlines are always the Fed really has tough tasks now because of the war, and the Fed really has a tough situation now because of jobs, unemployment. We had 92,000 jobs lost in February, but now oil pricing's going up. So it's like a really confusing, hard situation. The poor Fed, don't you feel bad for them? They have such a hard policy decision now on what to do with rates. My suggestion is that these type of headlines are such a joke. I mean, nobody feels bad for the Fed and how they have a tough job ahead. My suggestion is to shut up and buy Bitcoin. Bitcoin's a hedge to all this BS stuff about the Fed and their hard decisions ahead. I think that is so stupid. Nobody cares about the Fed and their hard decisions. They are incompetent, the Fed, because they're humans and humans shouldn't act like God. They shouldn't have the power of God, which is interest rates and QE and QT. What they should do is probably just lower interest rates at this point, to be honest with you. That's my opinion, but it's really, it should be a free market. It shouldn't be controlled by a bank in New York. All right, so those are my thoughts, and I'll leave you with this. If you guys watched till the end, I will show you my stock portfolio as of Friday, how I performed. These are the type of companies I own. So you can see here, I have Palantir and Raytheon, Lockheed Martin, Northrop, L3 Harris. I've owned those companies for over 10 years, and I've added them maybe a few times. So I'm very heavy in defense manufacturers, not heavy, but it's about 10% of my portfolio if you include Palantir. And then I'm heavily invested in tech. If you can see, I have AppLovin, I have NASDAQ 100, I have 16% of my portfolio is NVIDIA, Amazon, Meta, Apple. They're all large holdings in my portfolio, stocks I've held forever. Caterpillar, I have some industrials, and I have some financials. So very diversified portfolio, but another time I'll show you the portfolio. I'll show you my gains, my losses, and you'll see I'm very heavily invested in tech, just mega cap tech, which isn't popular and hasn't been popular. It's been consolidating for quite some time. So what we did was we talked about Goldman Sachs today and how I think it's starting to look attractive. I'm not saying I'm going to buy it on Monday. I think American Express is starting to look attractive, but I'm not going to buy it on Monday. I think Berkshire Hathaway, I'm going to hold off on adding more to my position there, even though I wish I was buying while Greg Abel was buying, and they're not going to tell you again when they do buybacks. They actually just wanted to tell you one time that they were doing it. They felt that it was time for Greg Abel to go on TV and let everybody know that he's the captain. But it was clear to me on that Squawk Box interview that Greg Abel just did this one time to let people know he was buying the stock and that he thought Berkshire Hathaway was trading below its intrinsic value. And that is their motto. Anytime it does, they buy back shares. They haven't bought back shares for like 2 years. So that was kind of Greg Abel's introduction to being CEO, and his interview went fine. I think he's a very smart guy, and he's going to do well running the company. So yeah, that's about it. Thank you so much for watching. You can find me on Substack under Rigatoni Capital. I write a newsletter and on long-term investing in stocks and Bitcoin and stuff like that. You can find me on YouTube, Spotify, Apple Podcasts, and other major podcast platforms. Thank you. Take care.